Want to maximise your tax savings before the year end? Well, watch on. As business accountants, my team and I spend all day long helping business owners on their journey. And of course, as we're approaching the end of the personal tax year, which ends on the 5th of April, there's a lot of stuff that you could do to make sure that you get the maximum from all of your different allowances. And in this video, I'm going to touch on quite a few of the key ones that you need to consider. So before we get into it, if you like these type of videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So what can you do to save tax before the 5th of April? Well, you've probably seen, if you're signed up to any of these things online, you know, there'll be some checklist of all the things you can do. But ultimately, I want to talk to you as business owners, particularly about the things you can look at. So whether you're a limited company owner or whether you're self-employed or whether actually you might even be a property owner, there's a couple of things that you can do and key areas to look at right now. A couple of these things would be relevant as well if you're just a personal tax type person that has to do a tax return for some reason. So whatever your circumstances, I'm sure there'll be a key point in this video. So let's get into it. Let's start off first then with limited companies, because that's quite a big thing. It's one of the things we get involved heavily in, and I think it's worth talking about dividends. So if you're a shareholder director of a small limited company, which is very normal, you probably take out quite a bit of your profits in dividends. And if you do, let's have a look and make sure that you're utilising the £2,000 dividend allowance. So at the time of recording this video, you can have £2,000 from the company tax-free, presuming there's enough profits to do so. That's really good. And a lot of small startups sometimes miss this one because they think, well, okay, I want to keep the money in the business, you know, I don't want to take it out. But actually there's an opportunity to say, we could earmark and declare some dividend for the next tax year in this tax year, even if you physically don't take the cash out. There's other videos we've done on this, but just know that if you haven't taken any dividends this year, you might want to look at declaring yourself some, presuming that the company can on paper do that. So that's a big one. And then on the dividends themselves, if you're earning under £50,000, the dividend rate's pretty attractive. You know, when you take out dividends over those first 2,000, if you're earning under around £50,000 a year from all your sources, those dividends are likely to be around 7.5%. But they do raise the other side of April to 8.25%. So they're going to get relatively expensive. So you want to make sure you're maximising the amount of dividends up to that kind of 50k level now this side of the year. So if this is you and you've got some potential to take some more dividends, it might actually be worth paying some more tax now because technically it's cheaper than it would be the other side of April. And that actually applies even if you're over 50,000. If you're taking out big sums and you know next year that you've got even bigger sums to come, it's actually technically cheaper to draw it now, albeit your tax payment on that's going to be a little bit earlier because you're taking it in this tax year, so it's your next tax bill. If you're looking at overall what's cheaper, it's going to be cheaper this side of April. So there you go, dividends. I could talk forever on that, but just know that it's worth reviewing those couple of things, dividend allowance and where you are with your kind of tax bands to make sure you're utilising them. In terms of director's salary, there's other videos we've done talking about why director's salary for a lot of people is important. So let's just say it's your sole income and you're a owner, director of a limited company. Very often having a salary is a really good idea to make sure that you're getting what they call a state pension qualifying year. So that's really important. So let's just say over about 6.5 grand-ish as a minimum, but there's also quite an efficiency at sort of just under 9 as well. So it depends where you are and everything else, but just make sure again that you're not missing out with where you're going. The reason the 6.5 is important is that's the bit that in one job is going to give you the state qualifying year for your state pension basically, which adds to the amount you're going to get when you retire, and missing those out over many years can actually end up costing you in terms of the pension you're going to receive. So definitely do that. And there's also a corporation tax saving for the company on that salary, so definitely check those out. And there's tons of videos we've done on why that's important, so do check those out as well. Then let's talk about generally what else can we do. So if you've been into your crypto or you've got any other investments you're thinking of selling, so you might have some crypto that's made some profit and you're thinking actually now might be a good time to cash that in. If you've got an investment property you're thinking of selling, you've got some shares you're thinking of cashing in, all those things, it's worth looking at now before the 5th of April. If you've not disposed of anything else this year, you get a separate allowance. It's about £12,300 at the time of recording, and that's a use it or lose it. You can't roll it forward. So sometimes it's a good idea to get rid of some of it now and maybe some of it just the other side of April. Depends what you're looking to dispose of. Obviously you can't really get rid of half a house before now, but if you're thinking of getting rid of your property and you haven't disposed of anything, that can be quite good. Same with your crypto. If you're thinking of getting rid of some of your crypto, maybe get rid of some of it now and then review the other side of April. So don't lose that allowance. I always think the worst thing to do is know that you're going to sell it and say like when soon, and then you sell it all next year when you could have sold some this side of the 5th of April and some next side. So yeah, think about the timing of that and don't lose that allowance if you have the big stuff. A couple other bits, if you're looking to donate to charities, there's a small saving if you're a higher rate taxpayer. If you're not, so let's say you're earning below about 50k, there's not a lot of benefit. There's benefit to the charity, but maybe not a lot of benefit for you personally. But yeah, if you are thinking of making any charitable donations, it's quite a good time to do it. On top of that, you've also got things like interest. So most taxpayers, it's a bit unknown really. There's this big thing around ISAs. ISAs are tax-free, you can put money in them, and they are in the right circumstance really good things. But bear in mind, most taxpayers can earn between £500 and £1,000 of interest tax-free anyway. So when you're comparing rates, consider, well, actually, do I need to be in an ISA if the rate's rubbish when I could have it in a higher interest bearing account, because you're probably not going to pay much tax on that anyway if your interest is under those kind of brackets. So have a look at that and think about it. But if you do need to sort of shelter some off in an ISA, again, there's an allowance each year for you to then go and utilise. So you might want to go bung some money in an ISA. So think about those ones. If you're married, it's worth thinking about whether you can transfer some of your allowance to your spouse. There's some very tight conditions on this, and the most important one being if one of you is a higher rate taxpayer, it doesn't work. But if you're both under about 50k, there might be the opportunity to transfer some of your marriage allowance, and you can actually backdate that as well. It's all kind of done online, so do think about utilising that as well during the year. And if you may be getting on a bit and you're thinking about, well, I'd like to pass some wealth down to the generations, there's a small inheritance tax thing that's worth bearing in mind, and that's that you can give cash gifts of up to £3,000 a year, and they don't count towards your estate. So that's quite a nice one if you're just thinking of parting with some money. So think about potentially shelling out some nice little presents before the tax year end. And from a personal point of view, there's another thing to consider, and that's whether you want to put any money into your pension. So as a business owner, quite often you might not have put anything throughout the year regularly, but you can still make a contribution during the tax year, and you can ultimately get, in a company, you could potentially get a tax deduction on it if you're thinking about using the company making the contribution rather than yourself. And again, we've done other videos on that, so check that out. But do know that it's worth thinking about whether you want to make it. And the reason that you do that as an individual or the company is there is a limit each year to the amount you can put in, and it's not quite lose it or use it, because that one you can kind of drag forward into other years, but there are time limits on that. So you do want to consider each year whether it's worth it. But ultimately, if you're a limited company, you might want to do it to save tax in your company year end anyway. So yeah, if you're looking to go into pensions, consider whether you want to make any contributions. Then let's talk about buying the big stuff. So we said about selling it. If your company year end is say the 31st of March, you're a limited company, or you're a sole trader, and you've got the normal tax year end of say 31st of March or 5th of April, then if you're going to be buying some equipment in the next couple of months, now is the key time to do it. I'd never say to you, if you've listened to me talk about this, I'd never say go spend money to save tax. It's a stupid idea, because if you spend say 10 grand, you might save say 2, so you've still spent 10 grand to save the 2 grand tax. But if you needed it, you were going to do it anyway. Bringing it forward this side of April is going to impact your next tax bill. So that's quite a good thing quite often. Again, it depends on your exact situation, but just know, yeah, the worst time I always think to buy something is like the 6th of April. It's like you could have bought it and then it's going to impact that next tax bill. So do maybe think about bringing that forward just a little bit. So a little one for landlords that actually comes in line with a lot of kind of general business tax planning advice, in that if you're going to do any repairs, say in the next couple of months, it's a good idea to bring them forward to do it before the 5th of April, because it's going to impact your next tax bill positively. If you're going to spend the money, you potentially get a tax deduction in this tax return, and it's going to impact your next tax bill rather than waiting ages away before you feel the impact. So have a look at that. And as I say, that applies generally in business. If you're going to be spending some money in the next couple of months, is it worth bringing it forward to bring that next tax bill down? And there's a balance of things to consider, because there might be a reason you want to show higher earnings and not have that sort of reduction in your profits and things like that. But just generally from a tax efficiency point of view and a cash flow, it's quite often worth bringing it forward. So there you go. Whether you're a limited company owner, a self-employed, landlord, or an individual, there'll be some tips in there for you. But as always, it's a mini disclaimer. Please do check with a professional before doing any of this if you want the absolute best tax efficiency. Until next time, please do share this with anybody who needs to know this, and I'll see you in the next one.